Welcome back. Efforts to tame inflation by raising interest rates, especially by the U.S. Federal Reserve, are affecting the $1 exchange rate here in South Korea, which in turn appears to be fanning fears about financial stability. For more on this reality and ways to address it, I have Professor Choi Sangyup from Yonsei University. Welcome, Professor Choi.
Thank you.
I also have Professor Cho Kyu Bong at Handong Global University live on the line. Professor Cho, it's a pleasure to have you with us.
Thank you.
Professor Cho, we'll start here then. Let's begin with the declining value of the Korean won against the US dollar in recent days. Perhaps we could start with a few words on the cause of that decline and the consequences.
Sure. So let me be first clear that the depreciation of Korean currency won is mainly driven by a strong dollar, which is a global phenomenon. That indicates that it's not a particular problem of Korean currency, giving us some comfort given our painful experience from financial crisis and taper tantrum more recently. Let me give you some specific numbers. So this year, both euro and British pound have depreciated about 12% against the dollar. And this number is even higher for Japanese yen, which is known to be a safe haven currency, by 20%. So in this sense, about 10% depreciation of Korean currency doesn't necessarily signal that the Korean economy is in trouble. However, as long as this strong dollar continues, which I believe so, the weakening won will also prevail. So this is because of the relatively expansionary monetary policy stance of the ECB and BOJ compared to Federal Reserve. So to understand the consequences of this weak won on the real economy, we have to consider two contrasting channels through which weaker currency affect the real economy. So the first channel is trade channel. So weakening won will make domestic exporters more competitive in foreign market, which will increase their net export and eventually GDP. However, we also shouldn't forget about the second channel, which is called the financial channel. So according to this channel, the strong dollar worldwide will increase the funding costs of domestic firms and banks from global financial market, which will decrease their credit, investment, and eventually GDP. So of course, at this point, we need more rigorous analysis to determine which effect is larger. But to me, it seems like that the downside risk coming from the second channel is dominating.
All right, I see. And against the backdrop then, Professor Cho, speaking to members of the foreign media in Bali on the sidelines of the G20 finance ministers meeting, Finance Minister Choo Kyung-ho shrugged off short-term risks of capital outflows from South Korea despite its weakening currency. What are your thoughts?
I think that the Finance Minister Choo does not have a significant concern about the Korean economy. In particular, corporations have financial soundness. Theoretically, the capital flows can be determined by the difference of expected returns on investment between countries. Of course, investors consider the effect of change in foreign exchange rate as well as corporations' profitability for evaluating the expected returns. As for profitability, the more profits corporations make, and the more return investors expect. So many firms in South Korea are likely to have not so much serious problems in terms of profitability right now, based on the Choo's decision, Choo's thoughts. However, in the short run, external conditions such as global economic conditions and financial market conditions are also important factors for the capital flows and fluctuations of foreign exchange rates. Depending on these external conditions, the capital outflows temporarily can sharply rise, even though there is little serious concern about funds health and the financial soundness. Such a situation could not last long, but persistently bad or uncertain external conditions could hurt firms' health. Actually, that's the different scenario. So current economic situation seems to be uncertain. Actually, that's the risk, I think.
Right, so the uncertainty is the risk. And against that then, Professor Choi, the fall in value of the Korean won also appears to have affected our foreign exchange reserves. Would you like to elaborate on that a little bit?
Sure. So there are two starlight facts about Korea's foreign reserve. First of all, the level of foreign reserve itself is very high, which exceeds $400 billion. That reflects our trauma from Asian financial crisis. But at the same time, according to foreign reserve adequacy ratio, including like various factors like the value of imports or short-term debt, our position is not bad, but not really great either. So against this background, I like to emphasize that the declining value of foreign reserve itself doesn't necessarily indicate that Bank of Korea had to actively defend the value of Korean currency. And that's because if our portfolio is diversified in different currencies whose value also have depreciated against the dollar, it could look like a decline in the dollar value of foreign reserve. However, since we don't really have much information on the precise currency composition of a foreign reserve, it's difficult to say how much of the decline is driven by so-called the valuation effect and how much of the decline is driven by the active FX management of the BOK. But what really bothers me is the speed of decline in foreign reserve compared to other countries with a large holding of foreign reserve. For example, despite the depreciation of their currency, our neighboring countries like China and Japan actually observed the increase in the dollar value of their foreign reserve. So in this sense, the monetary authority should actively monitor the development of the FX market.
Right, I see. And Professor Cho, what do you believe are the broader implications of this drop in our forex reserves?
Actually, the Professor mentioned the numbers related to our foreign exchange reserve, right? And so let me again speak the actual number of a foreign reserve. So at the end of October, 2021, and foreign reserve have $469 billion US dollar. But right now, the level is decreased up to $438 billion US dollar at the end of the last month. The level of the foreign exchange reserve is $438 billion US dollar is not low historically. Professor already mentioned. Based on the level of foreign exchange reserves, over pessimism about the foreign reserves is a little relevant, I think. However, this situation is not optimistic. And the problem is the pace of decline in foreign reserves. In just 8 months, the level of reserves is down by 7%. I'm not sure how long this trend will last. You know, the level of foreign reserve is related to the central bank intervention in the foreign exchange market. So when the foreign exchange market is stable, there will be no reason for the central bank to intervene in the market aggressively. Actually, it depends on when the foreign exchange rate stabilizes under the condition of the world economy.
Right, I see. Professor Cho, do you suppose then that a currency swap deal with the US will perhaps serve to address some of the possible challenges resulting from the retreat in our forex reserves?
Well, people often say that we have to accumulate more and more reserve, especially in terms of liquid asset to prevent a future currency crisis. But we shouldn't forget that there is an opportunity cost of holding such liquid asset, which is low returns. So in this sense, having a currency swap line with the US could be a viable option to minimize such cost, at the same time prevent a speculative attack by sending a strong signal to market participants. So this kind of policy could be very effective during a liquidity crunch, like the episode we saw in March 2020. However, I don't think having a dollar subline is panacea, and I'm a bit skeptical about its role in alleviating pressure on won depreciation. And again, that is because the weakening won in recent days is not really driven by a short-term dollar liquidity problem. So it's also quite interesting that countries with indefinite dollar credit swap line have also experienced large depreciation, actually larger than Korean won. Nevertheless, it's, as a precautionary measure, it's always good to have an additional policy instrument if things go south.
Right, and that being said then, Professor Cho, are there any other options out there to perhaps address the current challenges faced by South Korea, aside from the currency swap deal?
Actually, it's a very difficult question, right? Honestly, it's difficult to suggest the truly effective policies to address the current risks in the foreign exchange market right now. I think the central bank's role is crucial. The Bank of Korea has raised the policy interest rate, including the recent big step. Basically, monetary policy is able to affect the capital flows as well as foreign exchange rate. However, currently, economic uncertainty might dominate the effect of such a monetary policy. In addition, the Fed has raised the federal fund rate significantly as well. This situation may make the recent difficulties complicated. So the future monetary policy is very important. Also, we can think about the central bank's intervention to address the current challenges through the appropriate timing and the signals to a foreign exchange market. I'd like to stress that the key player is the central bank, Bank of Korea, rather than presenting concrete policies.
Right, so the role of the central bank is very crucial then. Professor Che, Finance Minister Choo Kyung-ho has also spoken about exempting taxes on income from investing in Korean treasury bonds to attract foreign investment. What are your thoughts on this planned measure?
Well, first of all, many advanced economies are already exempting interest income on treasury bonds for foreign investors. So in this sense, we are moving toward the right direction in the long term. But policymakers also have to consider a careful cost-benefit analysis before preemptive implementation of the policy. And that's because the cost of this policy is quite straightforward, which is a decline in government tax revenue. But potential benefit for this policy is much more difficult to predict, and that is because it ultimately depends on the foreign investors' demand on domestic Korean bonds, which is also a function of so many factors other than the tax rate. I'm pretty sure the Ministry of Economy and Finance is doing their job and conducting careful analysis and considering many different scenarios.
Right. Professor Cho, President Yoon Suk-yeol's meeting with U.S. Treasury Secretary Janet Yellen largely addressed economic security, as mentioned by my colleague Choi Min-jung earlier on. What issue caught your attention with regard to their talks?
As you mentioned, the President Yoon talked about the expanding cooperation to economic security. Of course, it's important for both countries to make concerted efforts while global diplomatic relations become more complicated under the Russian invasion of Ukraine. However, I would like to point out another topic, and that's the necessity of policies for the economically vulnerable. Actually, I was impressed that they addressed the necessity of policies for the economically vulnerable. The words the economic conditions are, the more severe the economically vulnerable are likely to be. So I hope that the administration keeps focusing on the economically vulnerable in terms of a combination of a variety of economic policies based on the market mechanism.
Right. Professor Che, Yellen called for a price cap scheme on Russian oil during her talks with Finance Minister Choo Kyung-ho, who largely appeared to support that particular plan. What are your thoughts on this?
Well, it's a difficult question to answer because it involves both economics and politics, which is not my expertise. But given the political relationship between Korea and the US, the decision to join this price cap seems to be a reasonable decision. However, from an economic perspective, I'm not still entirely convinced by expected effect of this price cap on global oil prices and also global inflation for two reasons. First of all, I'd like to ask, what is the optimal price cap? And it's really difficult to pin down what is the optimum price cap. If the cap is too high, it's useless anyway. And if the cap is too low, then it could push out Russia from supplying global oil. So it will cause another problem. So even if we're able to find the optimum level of price, it still requires the participants not to leave this deal. But over time, participating countries have more and more incentive to deviate from this collusion. And especially, I'm not entirely sure whether China and India are truly participating in this scheme.
Right, a lot of uncertainty there as
Yes.
well then. All right, Professor Che, thank you so much for your time and your thoughts. And Professor Cho, thank you very much for being with us live at this hour.